briefly introduce Professor Karen Dynan. Professor Karen Dynan is a professor of the practice in the Harvard University Department of Economics and at the Harvard Kennedy School. She is also a senior fellow at the Peterson Institute for International Economics and Statistics. She previously served as Assistant Secretary for Economic Policy and Chief Economist at the U.S. Department of the Treasury from 2014 to 2017. From 2009 to 2013, Professor Dynan was Vice President and Co-Director of the Economics Studies Program at the Brookings Institute. Before that, she was on the staff of the Federal Reserve Board, leading work in macroeconomic forecasting, household finances, and the Fed's response to the financial crisis. Professor Dynan has also served as a senior economist at the White House Council of Economic Advisors and as a visiting assistant professor at Johns Hopkins University. Her current research focuses on macroeconomic policy, consumer behavior, and household finances. Professor Dynan received her PhD in economics from Harvard University and her AB from Brown University. Last but not the least, Professor Dynan is a proud Badger mom. Her daughter is pursuing a PhD degree in chemistry at UW-Madison. Please join me to welcome Professor Dynan.
Thank you for that kind introduction. I'm just going to hopefully back up my slides. There, our clicker isn't working. The keyboard, maybe the keyboard will work. No, the keyboard's not working either. It was working before. Yeah, you're in the Magic Touch. Just have to touch. Back up to the first slide. Okay, thank you. Thank you very much. Thank you everyone for coming. Thank you, Xiao for inviting me, and also to Ken, her predecessor, for inviting me to give this talk. And thank you to the Julie Plant Granger Institute for Economic Research for holding this talk. It really is a pleasure to be here. I'm going to talk about challenges for U.S. economic policy. I'm going to kind of build off my years of working in Washington, D.C., and talk about both challenges in the near term with the current economic outlook in the first part of the talk, and then I'm going to get to longer term issues for economic policy. I'll touch on high and rising government debt, the backlash against globalization, artificial intelligence. As I sat down to think about what I wanted to talk about, I really did kind of go back to those years working in Washington, D.C., and I thought, if I was sitting there, in the senior staff conference room at the Treasury Department, talking about kind of what policy processes we needed to be kind of running in the White House, and what kind of, things we should be looking at in terms of what the Federal Reserve was doing, I really tried to kind of think about, well, what are the most important issues that I would be advising the Treasury Secretary we needed to think about. So the near term I'm going to cover in this context of the three great macroeconomic surprises since 2020. I don't know, some economists may disagree about how surprised they were about these things, but I will say, as someone who's followed the economy over the course of my career and has spent a lot of time talking to people and talking to policymakers in the media about kind of developments over the last 3 years, these are all things that surprised me. So the first thing I'm going to start with is the limited economic scars left by the COVID recession. And of course, I want to start by just saying, the health outcomes related to COVID were, of course, kind of devastating. But here I want to talk about the economic scars. And just for context, I'm going to go back to a dozen years before the pandemic set in, when we had this terrible financial crisis, and then it led to what we called the Great Recession. And one piece of really important, or one strand of really important literature around the Great Recession is the scars that this terrible recession left on the economy broadly and on people. So just to give you some context in terms of the economy broadly, this is just a picture of kind of the actual path of GDP in blue. And then in gray, what I have is the Congressional Budget Office's estimate of where the economy would have been. And this is an estimate they did on the eve of the Great Recession. So before we went into that recession. And what you can see is that GDP, it fell, as it ordinarily does during a recession. That's the kind of definition of a recession, is the economy is shrinking, and then it starts growing again. Okay, so that's great too. It starts growing in the recovery. But you can see it never got back to that path that we thought GDP was on. Never got back to that path that at least the Congressional Budget Office thought we would be on if we hadn't had the financial crisis and the Great Recession. So scars at the macro level, there were also just kind of great human costs of the Great Recession. And I think it's just another really important literature is looking at kind of these human costs and just looking at it, it wasn't just that people lost jobs and kind of experienced hardship in the moment. They really kind of experienced hardship for kind of years to come. And so kind of there were all sorts of problems in the labor market. This is the long-term unemployment rate. So people who were unemployed for a half year or more. And you can see the gray bar is the recession itself, but you can see elevated long-term unemployment and all the kind of dysfunction that comes with that just for years after the recession. I don't have a picture of the labor force participation rate, but we saw working age people kind of dropping out of the participation rate, out of the labor force because they were so discouraged about job prospects. I remember just sitting in the Treasury Secretary's office, kind of briefing him on employment report after employment report in the early 2010s. So we thought the economy is in recovery now, and yet labor force participation is still falling. He'd look at me and he'd be so disappointed when I had to deliver that news. But it was just because job prospects were so dismal in that period. And this showed through to kind of households' financial circumstances. So this is important research that's been done around kind of what happened to household finances. And this is a graph that is just looking at where people's inflation-adjusted wealth was 2016. So this is actually after the labor market had normalized after the Great Recession. And it's comparing it to where household finances were on the eve of the recession. And you can see for the bottom 30%, the middle 30%, the next 30%, kind of, they're still way behind where they were prior to the start of the recession. It's really only the top 10% that's ahead of where they were. So kind of we had this scoring at the macro level, at the people level, and then we get to, things are going pretty well in the economy, we get to the COVID shock. Okay, and the COVID shock was dramatic. Okay, employment plunged 14% in April 2020 as the economy shut down. We saw, just to give you some context around that number, peak employment loss during the Great Recession was 7%. The unemployment rate in April 2020 spiked to 15% compared to with a peak of 10% after the Great Recession. And so this raised really, given what we had been through with the Great Recession, it raised a lot of concerns amongst people following the economy and thinking about economic policy, both about kind of the hardship in the moment that was going to come from this job loss, but we were really worried about the potential of economic scarring, given what we had just seen with this earlier recession, this idea that even after the pandemic is behind us and the economy is starting to normalize, because people have kind of lost their jobs, like there will be, lingering scars even after the pandemic is over. And just to give you a sense, this is just a table from a piece that one economist did in June 2020, where he was trying to estimate the impact on GDP of the various scarring channels of people, job loss, business failures, and so on. And you can just see very significant estimates that GDP might be kind of 5 to 6% lower over the longer run if we, because of scars left by the pandemic recession. So the surprise was that economic outcomes post-COVID have been much better than after the Great Recession. So just to give you a sense of kind of what we saw, this is repeating kind of the same exercise with aggregate GDP. And what you can see here is within a year and a half, actual GDP had not only kind of recovered to its pre-pandemic level, it had gotten kind of mostly back to this path that we thought we were on before the pandemic. Same thing at like the kind of level of human costs. We had disruptions in the labor market, but for example, we only had a short period of long-term unemployment after the COVID recession. We don't yet kind of have the data to do an assessment of what happened to household finances. But this is data the Fed puts out. It's kind of estimate. They're taking like what they're observing and the financial system as a whole in terms of household wealth, and then they're kind of parsing it kind of into different kind of groups of different income groups, what happened. And what you can see here, of course, kind of wealth it's much lower. That just tends to be the case in the lower income quintiles. But you can see that the numbers on top of the bars is the percent gain, kind of a significant increase in wealth, not just for people high in the income distribution in terms of the percent gain in their wealth, but kind of balance sheets being in better shape, even down lower in the income distribution, which is kind of not what you expect to happen in, after a period of very severe job loss. There are a lot of different things that were different about the COVID recession than the Great Recession. I mean, it was a different economic environment. There were different causes. There were kind of various elements of the policy response, but I think one of the important kind of pieces of why we saw these better outcomes is at least in part kind of a much more vigorous policy response. So we saw kind of considerably larger and faster kind of fiscal support put in place relative to the Great Recession period. This graph here is just showing you kind of estimates of the policy response as a share of GDP to the Great Recession in the blue bars, breaking it down into kind of the different pieces of the response, the different bills that were passed, compared to the response to the COVID-19 that they had to the COVID-19 recession. You can see that orange bar is kind of taller than the blue bar, okay? In these estimates, the orange bar doesn't even include the 2021 American Rescue Plan, which was a big part of the fiscal response, which is estimated to have distributed half again as much as the pandemic legislation shown. So picture that orange bar being half again as tall. Okay, so I will come back on that policy response, but I think that was probably part of it. Okay, so second great macroeconomic surprise. And this one probably occurred to you when I said I was going to talk about surprises, the post-COVID run-up in inflation, okay? And to give you some context, okay, like I spent a good part of my career at the Federal Reserve Board in the central banking world, and in the late 2010s, policymakers were kind of patting themselves on the back about how well they had done with monetary policy. We had had a period of terrible inflation in the early 1980s, but then kind of over subsequent decades, they managed to wrestle inflation down to their target 2%, very low and steady inflation. And it's just kind of, you can see it just kind of stays at 2%. There are all sorts of kind of fluctuations in the economy, and in particular in this period in the late 2010s, which is a pretty strong labor market. Okay, so you learn about how strong labor markets may be associated with inflationary pressures, but not then. And central banks just really felt they had nailed it, that we weren't going to have to worry about inflation again. They in fact got into all sorts of other kind of policy questions. They started thinking about the green transition and how they might help, and kind of they were thinking a lot about the income distribution and how they might promote economic mobility. But then we get COVID, and inflation is well behaved for much of that time. In 2021, inflation accelerates again, and we get back to levels of inflation we have not seen since the early 1980s. So this was pretty shocking as a development. Okay, inflation began to pick up in 2021. It was initially misread as transitory, and for that reason, there wasn't a policy response in terms of monetary policy until early 2022. This is just a screenshot of news coverage of a famous speech that Fed Chair Powell gave about, it was in August 2021. Okay, so several months after we'd seen inflation start to pick up. This is his famous Jackson Hole speech. He does it once a year at this big central banking conference in Jackson Hole, Wyoming. And he gave this kind of long analytic speech about like all the reasons the Fed felt that this episode of inflation was just transitory. Inflation was going to settle down by itself. He has, since I think come to regret this long analytic speech. And in fact, I was at Jackson Hole this year and last year. His speeches since then at the Jackson Hole conference have been very short and very to the point. We're on it with inflation, and we're really committed to that 2% target. There was speculation this year that maybe he'd go back to an analytic speech, but he just wasn't going to go there. I want to say the Fed was in good company. I'm not really just kind of taking on them. I was just looking at forecasts that come from a Wall Street Journal survey of economic forecasters done in July 2021, so about the same time as Powell gave his speech, a little bit earlier. But you can see, forecasters, they recognize we're going to get 3.2% underlying inflation this year. Okay, so that's higher than we've seen for a long time, right? Because we thought we'd conquered inflation. But by 2022, next year, inflation is going to be back really close to target, just a little bit above target at 2.3%. Looking into the microdata for the survey, there was one kind of brave forecaster. The highest forecast in there out of 60 people was 4% inflation for 2022. Core inflation actually came into for 2022 actually came in at 4.8%. Okay, so this inflation thought to be transitory, but going, a year later, it's not only kind of high, it's higher than it was in 2021. Okay, so hindsight is always better than foresight. We have a better understanding now of what went wrong, why inflation picked up on a sustained basis. So going into 2021, it turned out there was a lot of pent-up desire to spend. We come out of this pandemic, people are getting vaccinated. They had not done so much of the consumption that they would ordinarily do because they're kind of avoiding all high contact services. And you can see this in this graph here. This is just a graph of real consumer spending. It does go back to the pre-pandemic trend. But there's no sense in which it made up for this whole period of suppressed consumption. And some of that consumption is never going to be made up, right? If you missed a haircut in 2021, it's not like you're going to get extra haircuts in 2022. But certainly if you waited to buy a car because you didn't want to be exposed to COVID at the car dealership, you're going to make that up. But beyond that, there has been a lot of people saying, well, there are other components of services like travel, and entertainment where people really do seem to want to be making up that spending. So there was this huge pent-up desire to spend. And there was also great wherewithal to act on that extra demand because people had saved a bunch. So they had saved a bunch partly because they hadn't consumed the prior year, hadn't been out consuming high contact services. But also, as I said before, they've gotten this generous support from the government. So lots of job loss, but that income was replaced. For some people, it was more than replaced. Okay, so this is just a graph by researchers at the Fed of kind of excess pandemic saving. So in the sense, higher than average saving. And again, what I want you to see here is that it's by income quartile. So the red is the lowest quartile. Normally, we would think in a period where the economy is in a slump, those people are not going to be saving at all. But you can see pretty substantial excess saving for that group. And then as you go up the income distribution, you're getting really large amounts of excess saving for people to kind of act on. So they had the wherewithal to finance the pent-up demand. Okay, so that's what's going on the demand side. And I think it was kind of under-recognized how much kind of demand was out there. And then at the same time, as I think a lot of you probably recognize, supply, the productive capacity of the US economy just wasn't able to ramp up fast enough to meet this demand. And this was like a variety of factors, right? So the thing, in 2020, and I think people correctly identified this as a transitory story, but this is just it's a picture of ships. It was just like such a striking thing that ships were kind of stacked up at ports outside of LA, right? Because they couldn't get enough goods into the economy, to satisfy all this demand. We had these supply chain disruptions, right? People have talked about, couldn't get enough semiconductors to build the cars we needed to build, okay? So that's another thing going on the supply side. Something we didn't really kind of anticipate. So not all these things were, I think part of the problem was not just that the shocks, was not just, the labels we put on the shocks that we saw in 2021, we saw additional kind of shocks on the supply side. China was still dealing with these kind of rolling, shutdowns because they were, by 2022, they're kind of dealing with the virus in their country, but that's messing up supply chains. Then big and broad, and I think this one was really kind of under-recognized as well, was a worker shortage that was going to kind of constrain the productive capacity of the economy. So, you have the strong demand and you have these constraints on supply. And really, I think, what went wrong, I think boils down to the fact that people did not anticipate this large, sustained imbalance between aggregate demand and aggregate supply in the economy. Okay, third surprise. And here I'm gonna be kind of optimistic, okay? And I'm gonna be moving now to the kind of near-term economic outlook. The soft landing that seems to be beckoning, but I don't think it's assured, but let me tell you. So in response to all this inflation, Fed did, they were a little late to the game, but they did what they were supposed to do, which is they had kind of an aggressive response in terms of monetary policy. You can see the Fed funds rate, their policy rate in blue. They're kind of ratcheting it up, meeting after meeting after meeting. Once they kind of get on they do start to act in early 2022 because they realize it's not a transitory problem. Okay, and then you can see with it, I stuck the 30-year mortgage rate on here. I could stick other other variables related to financial conditions like equity prices and stuff like that. We're just seeing this tightening of financial conditions in the economy. And let me be clear, this is what monetary policy is trying to achieve. They're trying to tighten, they're using the tools they have, they're trying to tighten financial conditions broadly to curb demand, to kind of correct the imbalance between demand and supply in the economy, also to keep inflation expectations, which is another component of what can lead to high inflation is if people start to expect higher inflation, but they're trying to kind of demonstrate their commitment to getting the economy back to normal by raising rates so aggressively. So they're trying to keep inflation expectations in check. And so it's an aggressive tightening of monetary policy. What they're hoping to do here is kind of achieve a Goldilocks outcome, a soft landing, okay? So what they're trying to do is they're trying to damp demand, but just enough such that they're not throwing the economy into, they're correcting this imbalance, but they're not throwing the economy into recession. So that's what they're trying to achieve, this soft landing. Historically, been hard to achieve, okay? This is a graph you kind of have to look at it for a minute to understand what I've got here, but I've got the Fed funds rate, that's the Fed's policy rate in gray, and then I've got the unemployment rate, right? It's signaling, that's a signal of whether we're in a recession or not, when the unemployment rate goes up. But if you kind of look at this graph, kind of stare at it for a while, what you realize is that historically, when the Fed's had big increases in its policy rate, now look at the early 80s, look at the early 90s, some evidence of this happening around the year 2000. They're tightening before the Great Recession. What you see is historically, tightenings have often preceded economic downturns, okay? So a lot of bearishness about we're probably not gonna get this soft landing, we're gonna get a hard landing. And so what we saw was a lot of economists growing bearish about prospects for the economy. This is from, actually it's the same survey I was referencing before. It's a survey of economic forecasters. You can find the data yourself on the Wall Street Journal website. Odds that forecasters are putting on a recession starting within a year, okay? Fed starts tightening policy in early 2022. And you can just see as they tighten policy, you know, again and again, very aggressively, and they're using strong language. We're really committed to getting rid of inflation, to stamping it out. We get to very kind of bearish predictions about the economy. Like more than half, and this is still true, more than half of forecasters think that the odds are we'll be in a recession within a year. Okay. So bearishness, what I have found, and I was bearish myself 9 months ago, okay? The news has been good though. And it's just been very encouraging in terms of what we've seen. Labor demand has slowed, just like the Fed wanted it to. They wanted to correct this imbalance. But we haven't got into recession. It remains healthy. This is a graph of, you know, employment growth, change in payrolls, okay? You can see the 3-month trailing average. The bars are monthly changes. And we've got the 3-month moving average to smooth through monthly volatility. It's coming down, okay? That's great. Is that a weak rate we're at? No, it's not a weak rate. What I plotted here on this black line, that's the estimate of neutral. That's normal neutral employment growth by the Atlanta Fed, 100,000 a month. It's in a normal economy, that's what you'd expect. It's coming down, but it's not falling below normal. Unemployment rate, notwithstanding this really aggressive tightening, remaining at the super low level, okay? So as low as it was in this really strong kind of job market that we had prior to the pandemic. Okay, so that's great, okay? Managed to slow demand, but not too much, okay? But what's going on the inflation side? Well, this is the part I think that has surprised a lot of forecasters. Inflation's been nonetheless retreating, even though the economy is pretty strong. Okay, so this is the Fed's favorite measure of inflation. I've plotted different lines because you don't want to just look back a year. You want to see what's happened more recently. The 3-month change is the more timely measure, even though it tends to be noisy. But look what we've got going on. Okay, we got as high with underlying inflation. You know, we saw numbers up there around 6% on the 3-month change. It's coming down. It's come down a bunch. If you look at that 3-month change, it's like 3%. It's getting closer to 2%, the target, okay? Moreover, great news on inflation expectations. Inflation expectations, they went up for a while. People were so concerned about inflation. They've come down, not all the way, but much closer to the pre-pandemic range. So this is all very promising in terms of a soft landing. My own view is we can be cautiously optimistic about soft landing, but we do need to recognize there are risks on both sides, okay? So on the side of the economy still being overheated, okay? First of all, you know, getting down, we may be done with like the easy part of disinflation. Like inflation's come down a bunch. The remaining part might be harder. We need to recognize we're still 1% above the Fed's target. It doesn't seem that big when you consider, you know, a year ago we were 3% above the Fed's target. 1% would be pretty shocking if you had told economists in the late 2010s we were 1% above the target. And I think there are multiple factors that could generate sustained overheating and ongoing inflation pressures. And do you remember we had this terrible inflation in the late 70s, early 80s? We got inflation down, and then in the late 70s, and then it re-accelerated. Excess savings, okay? If anyone tells you they know what's going on with excess saving, whether we've exhausted it or not, I don't think we know. We don't have the micro data to really kind of accurately assess how much saving is in different parts of the income distribution, and the estimates based on macro data are just really sensitive to the assumptions that you're using. So possibly there's still a considerable amount of excess saving out there to drive demand. On top of that, even if people are running down their saving, we've got strong labor markets supporting incomes. Okay, good news for workers, okay? Just kind of posing risks to the macro economy. Then there's this is really the bad news scenario, would be the potential for another inflationary supply shock. So for example, in the last few weeks, we've seen oil price futures go up a bunch. But that's the sort of thing where kind of the oil prices go up, it translates into gasoline prices, it starts affecting people's inflation expectations, it starts getting into input prices. That's the sort of thing you could see driving inflation back up, okay? That's on the inflationary side. What that means for the economy, kind of, you know, if that happens, is the Fed's eventually gonna have to jam on the brakes harder and put us at greater risk of a hard landing. Now, I will say, I think the risks are really two-sided. I also think there's a compelling story. One can tell that there's actually more incipient weakness in the economy than we thought there was. So monetary policy, you probably learned this from David Johnson, it affects the economy with a lag. We don't actually really have a great handle on what the lag exactly is. So we don't know if all the effects of the 5 percentage point tightening in monetary policy we've seen so far have played out. We've got problems in the banking sector. We had some real problems last March. Most economists, I think we addressed the acute problems in the banking sector. But I will say, commercial, because of the switch to remote work and the problems office buildings are having with vacancies, there's real worry about commercial real estate troubles. I'm creating what my colleague Jeremy Stein, who's an expert in banking, calls a slow burn in the banking sector. That it's not, we're not going to see another dramatic Silicon Valley bank event, but we could see kind of just slowly kind of developments that kind of hurt their balance sheet over time. There's that, and then there are, I think, there's weakness abroad. China. There's a lot of stories right now questioning whether the Chinese economy has kind of weaker underpinnings than we thought it did. But there are also stories that Europe may go into another recession. Okay, so risks on both sides. Okay, so let me now, that's kind of short term. Let me now spend a few minutes on longer term issues for economic policy. Okay, so this is, I'm advising the Treasury Secretary. Of course, we got to get through this kind of, period of inflation and try to stay on the narrow path towards a soft landing. But what else over the longer term do we need to worry about? High and rising federal debt. Okay, so let's start there. Okay, so federal debt, here, let me put up all the graphics. Okay, we already knew we were in trouble with federal debt before the pandemic. So here's where we were before the pandemic in terms of the federal debt to GDP ratio. And what you can see is that it's at its highest level, that it's been in decades and decades and decades. We knew that even, that things were going to get worse. We knew this because the population was aging, healthcare costs were rising, and these, given the way our programs are set up, we're going to drive debt up even further in future decades. Okay, but then you get recessions, and recessions can be very hard on the federal budget because government's spending money, they're not collecting as much taxes, and you can see they're bad for the budget, and you can see debt ratcheting up after the Great Recession. Again, COVID, right? Spend all this money. I told you there were a lot of good things of spending all this money. Kind of really, in my view, important part of avoiding those economic scars. There are trade-offs. Talked about one trade-off, which was maybe overheating the economy. Another trade-off is, look, federal debt is now 100% of GDP. So we are right up here at this peak. We're in kind of during World War II before. And this is what the Congressional Budget Office, this is where they think we're going, given the other forces that are going to be the kind of aging population, rising healthcare costs. And that's a problem. I have a slide, the next slide's on the costs, the risks and costs around these high levels of debt. Let me just say, first of all, just on like the policy options here, adjusting spending and taxes enough to put debt on a sustainable path, okay, is going to involve a hard decision because all the decisions are going to have significant social costs. Okay, these are the major component. You can break down the budget this way in terms of the major components of the budget. And this is what I was hinting at before, which is you can see the aging population, healthcare spending. You can see kind of relative to 50 years average, we're just projected to kind of, that component's projected to soar. Hard to know. First of all, we don't really know what to do to tame healthcare costs. That's a technical problem. For Social Security, which provides income support for older households, can it be cut? I mean, in principle, it could be, but you have to worry about, first of all, the fact that there are a lot of kind of older households who are very vulnerable. So how do you kind of cut this program so that you're not hurting vulnerable people. So that's a big issue there. On top of that, the politics are messy. This is our Social Security is our most popular social program. And it should be our most popular because it is doing so much good for society. So that political popularity has basically led a lot of policymakers to kind of just take it off the table in terms of something that we're going to cut in order to fix our budget problems. Okay, but then it's like, okay, well, can we cut other spending? Well, look, where we're projected to be, within a few years, we're projected to be kind of well below the 50-year average of the other types of spending. What is in this category? Well, national defense is in this category, okay? A lot of people are against cutting that, and we are arguably living in a more dangerous world these days. Education spending is in this category. Infrastructure spending is in this category. The things they're doing to support the semiconductor industry are in this category. So, prospects for squeezing this category further will have some real trade-offs. Some of those trade-offs will hurt economic growth, in addition to hurting people and mobility. So that's a hard category to cut. Some people are like, well, let's just raise taxes. I just want to put this out, and there are ways to raise taxes. I want to put this out as a cautionary note, though. We're already above the historical, raising taxes is not popular politically, but on top of that, we're already projected to be above what the historical average share of GDP going towards taxes has been. So hard trade-offs, okay? That's the central message there, but these adjustments, they need to be made, okay? Anyone who's taken economics, there are just like huge problems with kind of high and rising federal debt. Economists disagree right now about like whether the current level of debt is too high. It seems like investors are still willing to buy our government bonds, but almost everyone I know thinks we can't get debt to be 180% of GDP without significant costs. You've got kind of budgetary costs, with a greater share of government outlays going to making payments on debt. So it's going to crowd out other types of spending. You've got something economists call kind of crowding out, which is you're diverting loanable funds, like money people have saved, to funding the government and away from funding kind of private sector projects that might kind of enhance our capital stock and therefore be important for economic growth. And then you've got some pretty bad kind of longer run outcomes. High debt can be inflationary if people come to believe the government will eventually resort to printing money to finance spending because it's hard to borrow. But then you have these kind of truly bad outcomes that you'll get if debt goes high enough, where you have a debt crisis and the country loses the ability to borrow because investors just don't believe the government's going to be able to pay the debt. Okay, so hard choices need to be made. Okay, few slides on the backlash against globalization. Globalization's had many benefits. You'll learn in your introductory economics class that globalization means more specialization. So that means more goods produced at lower prices. That seems good for us. Globalization has increased incentives and the ability to innovate. Selling into a global market, the returns are going to be higher if you hit it big with your innovation. Even if you're kind of not looking at higher returns from kind of the larger market, you're also facing competition from abroad. So that's going to kind of drive you to innovate and be more efficient, more global exchange of ideas. And then a really super important, if you look at across countries, there's been this huge gap between rich and poor globally. So trade has helped some poor countries grow, which has lifted huge numbers of people out of extreme poverty. Okay, so it has its benefits, but the 21st century experiences have really revealed some important downsides of globalization. And one is that it may have been good for global disparities in income. It's hurt some people in this country and other rich countries who've been displaced by competition from abroad. I have colleagues at the Kennedy School who've done very important kind of work on the China shock when China entered the World Trade Organization, and trade with China, import competition with China just grew much stronger. And then we saw certain parts of the country that were competing with the Chinese industries just suffer economic shocks that were just too big for them to get over. And it caused kind of not only a lot of hardship, but social dysfunction, political dysfunction. That's one of the trade-offs there. I also see, a lot of discussion in recent years in particular about kind of global supply chains, the fact that kind of you're working with the rest of the world to supply something. And, the thing people have been talking about is semiconductors, like, we need them for national defense. And yet if we're relying on other countries to produce them and there's some disruption in some other country, it puts us in a very vulnerable position. So we recognize these downsides. Downsides have generated backlash to globalization. I will say globalization has really not gone into reverse. This is just an index of trade openness. And you can see it's kind of flattened out in the 2000s, but it's not sunk. And you can this only goes through 2019, but you go to the World Trade Organization, you look at their index since 2019, you can see they think trade's just increased over this period. There were concerns even like even a few months ago, people have been talking about a shortage of foreign-born workers in this country due to immigration restrictions. You can see kind of the gap that started when immigration restrictions were put in place between kind of actual foreign-born labor supply and the trend. And you can see this gap opened up, but the gap's closed again post-COVID. So really, we haven't gone to a reverse, but there is a lot of support for backlash. What I'll say in terms of economic policy, the downsides, addressing the downsides of globalization, it's just difficult. I have a couple of examples here. This is an important paper that was put out this summer that looked at kind of what's happened over time in terms of imports from China. And kind of these trade restrictions we put in place in late 2010s, they did reduce imports from China, but they actually increased, those imports were replaced by imports from other places. They didn't drive kind of production back to this country. And in particular, it drove imports, our imports are now coming from countries that are not China, but countries that are importing a lot from China. So it's not really clear. It's limited our exposure from China. We're using what we call industrial policy to try to revive a semiconductor industry in our country. Unclear how successful that's going to be. Taiwanese chip makers had said, look, you can subsidize these industries, but you're going to have to do it in a huge way because it's just so much more expensive to do it in our country. And we're not clear that we have the talent to make the chips. So it's just hard to make economic policy to address that. The last thing I want to mention as a policy issue is artificial intelligence. Okay, I got a couple of slides here. And the background here is just, and I was kind of worked a bunch on this at the Treasury Department. We've had real worries about productivity growth. This is like how much output we can produce per unit of input. It's just been dropping over time in the United States from an average of over 1% per year in the 90s and the early 2000s to an average of 0.6% per year. This slide should say since then. Okay, and this is just bad news. Okay, it means lower advances in the average standard of living. It means there are arguments you can make that kind of having a growing economy is actually really important to having economic mobility in your economy. And then it's bad news for that government debt I was talking about before, okay? Because we need that growth, we need that output, we need that income to pay off our debt, okay? One of the more concerning papers that's come out in recent years on this question is by researchers, I think most of them are at Stanford, that basically has documented that it looks like ideas are getting harder to find, just kind of more expensive. Like, the cost in terms of research dollars and the number of researchers has just grown, in terms of producing ideas, okay? And they think, and that, it's not clear how we get out of that. So anyway, we're in this situation, okay? And then AI comes along. Oh, maybe AI is going to, okay? Let me give you the 3 scenarios I'm hearing about in terms of AI. Okay, it's a bit of a characterization. I'm going to be broad here. One is, it's been kind of fun over the past year, but the AI developments, like the great leap forward, mostly played out. And these AI skeptics, we're really not going to get a lot more out of this AI, these recent AI advances. The second one, okay, is, oh no, these advances are really something important, but they predominantly will substitute for large groups of workers. I put here this quote from Tyler Cowen, but because this is what I'm hearing from my friends, is they don't need research assistants, economists anymore, because they're having AI do the coding. They're having ChatGPT write code for them. Okay, that's like a whole class of jobs that a lot of people take right out of college. So it's a lot. It's an important early job in terms of like the ladder you might be on, over the course of your career. Okay, but if we have this kind of displacement, we're going to get the kind of direct cost, but social and political dysfunction. I mean, think what we had with the China shock. And I will say the global South, okay, the rich countries in some senses will kind of okay because we can redistribute income, but to the extent that we're displacing workers in poor countries, and it's like, multinationals from rich countries, the income goes back to the global North, okay? So that's a threat there. I will say the happy story that I hear is that, no, we're gonna see big changes from AI, but predominantly those changes are gonna complement workers. So that whole story I told you about ideas, harder to find, AI is gonna find the ideas. AI is going to invent new professions for the research assistants who've been displaced. AI is going to dramatically change our business, the business that we're in, right? It's going to increase access to education. And finally, we'll be able to kind of produce it cheaply, okay? So those are the 3 scenarios I tend to hear about. I don't know which scenario is right, but let me walk you through policy implications. I think, the first scenario where kind of we're done with AI in terms of the advances, we're still stuck with all the problems I was telling you about in previous slides. The substitute one, that's the bad outcome, okay? You displace a bunch of workers, okay? You got to worry about all these costs I told you about. So, there, we should be strengthening the safety net. We should be investing in training displaced workers. We should be finding more ways for people to own their robots, okay? Tim's meeting, who's sitting back there, is smiling at me because we talk about this a lot, which is find more ways for people to own, for example, stocks, because that's owning companies, and the companies will own the robots. Okay, complementing workers, everything is better. Although I will tell you, if you stick the kind of productivity numbers into like analyses of the sustainability of government debt, so the kind of optimistic productivity numbers that people talk about, it's, our problems partly go away. It's not enough to put debt, that alone is not enough to put debt on a sustainable path. So it's not going to get us out of our problems. Anyway, this is my last slide, and then I'll take questions. Oh, and I should say, all scenarios AI, we need to think about the appropriate regulatory response. That's a different topic. Okay, just summary and final thoughts. Going back to the near-term prospects, we need to continue this fight against inflation. I think there are risks on both sides. I think policymakers really need to recognize that, as much as like no monetary policymaker wants to tighten conditions and it to result in job loss, but we need to be mindful that not curbing demand adequately today may lead to a much sharper tightening in the future. Fiscal, need to face up to those hard budget decisions. Enough said there. Policies to address the downsides of globalization. I think we really do have to admit there are some pretty important downsides to globalization, but we need to think carefully about these measures we're putting in place and really look at the evidence as to whether they're meeting their goals. And then I will say, strengthening the safety net and investing in workers' skills, I would say that's a generally good idea. It could help with the backlash against globalization and provide some insurance against the displacement, the hardship, the dysfunction that could come with scarier AI scenarios. So that's my final slide. I want to thank you for listening, and I think we have a little bit of time left for questions. So Shannon and Adam, did we get questions?
I think this is on. Yeah, we got a lot of questions, a lot of good ones. So going back to the earlier part of your talk, you were talking about the different policies that were implemented, that were implemented after the COVID recession. Yeah. And which one, in your opinion, do you think economists would agree was like one of the better ones? Was it like the Paycheck Protection Program, or increasing unemployment insurance, or the money market mutual fund? Which one?
Yeah, I did not mention the financial policy response. I should have said this. The financial system almost melted down in March 2020. I think a lot of us were dealing with terrible news about the pandemic, so we didn't notice. But kind of what the central banking community around the world did and swoop down, and open these liquidity facilities turned out to be really important. So those a lot of economists think those are great. I would say, I think economists are supportive of a lot of the measures we put in place, but I think there are questions of exactly how they were tailored. So no doubt the unemployment insurance was very, very important. I think there are economists who disagree about just its generosity, whether it was kind of not targeted efficiently enough. But not only did we supplement kind of the regular payments, which for most people don't cover their full income, we expanded it to cover groups of people who ordinarily would not be covered by unemployment insurance. So self-employed people, which would include like everyone who drives for Uber or Lyft, people who had not been in the labor force long enough to qualify for the normal program. So I think that was a really important program. I think support for small businesses was really important, but I think the evidence around payroll protection is not kind of clear yet as to how efficient it was.
Okay, I'm also going to remind you all, you can go on the app and even upvote questions that you're interested in. So no pressure if you don't have questions yourself, but you have a say in the questions that we're going to ask. So just, do it if you would like. So the next question we have is, you mentioned that, rising government debt is a huge challenge the U.S. is facing in the coming decades. What policies do you think the U.S. might implement to reassure its debt holders, it's capable of paying them back?
Yeah. I mean, I think, the sooner we can make some of the hard decisions, the better. But I do think it will work out much, much better if we can get Americans behind the decisions we make. So I think we should probably work out a set of principles. I mean, on my list would be not doing things that hurt economic mobility, not doing things that hurt vulnerable Americans, not doing things that are going to kind of hurt growth. So I would agree on that set of principles. I do think there are kind of process questions. I would like to see these decisions made on a bipartisan basis. So I really do think there is a role for kind of, in the past we have used kind of bipartisan, sometimes they're independent commissions to advise Congress to come up with a deal. And then kind of everybody kind of leaps in and supports it. But that would be my ideal world, is where we get something that does not just sound like it was jammed through by like one party or the other, but there really is kind of agreement that these are the right things to do.
Okay, thank you for that. So another question, this is, let me just ask it generally, but there's a lot of just interest in what the evidence is for the drivers of inflation. What do you think are kind of the things that are most stubborn drivers of inflation? There's some people mentioning corporate greed or price gouging that's been signaled by the Biden administration. The supply chain issues that have been also featured in that debate. But yeah, curious to get your opinion on those things.
I'm sure, really good question. I will say, if anyone tries to tell you they know kind of exactly what drove inflation, and therefore they know exactly where inflation is heading in the future, I would not believe them. I think if there's anything we've learned from the experience of the last, I guess it's been 2 years, is that economists really don't have a full grasp on what it is that drives inflation. And I would say, I was out at this big central banking conference in Jackson Hole this year, and, it was just a running theme amongst policymakers that, like, we need to be humble and we need to be nimble, and we need to be watching the data very, very carefully. So I will say that. I will say, I think kind of the evidence supports the view that certainly kind of, there just was a fundamental misalignment between demand and supply. And there were various contributing factors, including kind of, probably an overheating related to aggressive fiscal support, overheating of demand, but then these supply constraints. You mentioned the, and I should also say kind of the supply constraints, including importantly the worker shortage. You mentioned this greedflation theory. That the jury is still out amongst economists on that one. I think there's just a lot of disagreement about exactly what's been happening with like corporate profit margins. I will say businesses are always trying to raise prices. That's what they do. They're trying to raise prices and earn profits. So you really have to kind of ask what enabled them to be able to do that. And I think then you go back to the strong demand story. When demand is very, very strong, that just enables businesses to raise prices more. I will say, I think one interesting research question that we need to kind of deal with is that when inflation does go up, I mean, traditionally we do talk about this as a cost of inflation. It's hard for people to kind of judge what a fair price is. And I do kind of feel that even myself, that like I remember last year I was in an airport and like the Caesar salad cost like $18. I'm like, is this because of inflation, or is this because this is like a ripoff and I need to go down the concourse to get a salad somewhere else? And I remember I was like telling my students about this, and they're like, oh, that was just general inflation. But no, there's no way it was general inflation. It was just like there's some confusion about where prices are that does maybe also enables firms to raise prices.
Okay, thank you. I think we have maybe time for one question before the nacho bar outside. I know you guys are all on the edge of your seats, but let Shannon ask that.
Yeah. So earlier in your talk, you showed this graph, forecasters predicting the chance of a recession. And so we've seen that has been a non-zero probability over the past couple of years, well, even though demand side has remained strong. And so the question is generally about, do you think that forecasters are predicting a recession because the Fed was late to the game in terms of raising interest rates, or is it more that inflation, just hasn't gone down to what we would expect it to?
So I think forecasters are looking at what the Fed has done so far and looking what's happened historically when they tighten rates a bunch, and kind of seeing that it's just soft landings are hard to achieve. So that's one strand that I'm hearing. Another thing that I'm hearing, and I think this is right, all hard landings start off looking like a soft landing. So there's just general caution there. There aren't as many people. I've been more in the camp that inflation's stickier than we thought, and central banks, including the Fed, may have to go further than they think in terms of raising rates to knock out this inflation. I thought that for a long time. Given what we've seen in terms of the good progress we made with inflation, I'm kind of backing off that view. But I would not say that's a highly popular view amongst forecasters. I think mostly they're worried about incipient weakness that is unrecognized at this point.
Let's give Karen another.
Yeah, thank you so much.
Thank you, Karen, for a very thoughtful talk. And I also want to give thanks to Matt Carl and Shannon Slats, who are moderating the questions. And I want to also give special thanks to Tara Neiman, who single-handedly put all the pieces together to make this event happen.